Robert Drbul, Guggenheim Securities retail analyst. Bob has a buy rating on Nike and a price target of $135. Good to have you here on set. Why are you sticking with that rating despite the weakness we've seen this year?
Well, I think it's a great portfolio of brands in addition to Nike. You know, you have the Jordan brand, Converse as well. And I think from like a global opportunity, I don't think there's a better company that operates brand equity and connects with the consumers better than Nike does.
All right. The fact that we have seen selling in the name, at least until the last two trading sessions, why? Why the weakness?
I think there's a couple of concerns. I think, you know, China has been a big focus for investors and for Nike specifically. It hasn't been linear, but I do think they're in pretty good shape now. The inventory situation has gotten much, much cleaner. I think they're probably in the best situation on the inventories within the industry. I feel like there's some concerns on brand Jordan slowing, and I don't really share those concerns. I think that, you know, the business has some significant growth opportunities internationally, women's, you know, even in kids. And ultimately, I think the financial strength of this company, I'm never one to bet against Nike, you know, on the future of the business.
Yeah, I mean, China, at least in the last earnings, was a bright spot. It was much stronger than expected. It seems like, and we've seen this with a number of retailers, you know, or international apparel and retail names, or global, I should say, has been some softening or some weakening in the North American market.
Well, North America, I think they're working through a lot of issues. I think athletic generally continues to be a great growth category, you know, but there's a lot of movement going on between footwear, apparel, between men's brands, women's brands, and ultimately I feel like we're still working through the last few years of some of the supply chain challenges that the industry has faced. You know, I think Nike's taken some big steps to, you know, continue their strength and clean themselves up and clean the industry up over the last few quarters, and I feel like they're in a good spot as we look forward to the next year or so.
The margin declines that took place last quarter, is that over, or do you expect that to continue? I
think that's largely over. I think, you know, the inventories, they've taken some significant clearance and markdowns on the inventory side. They were also facing, you know, supply chain contracts that were a few years old, and now you're starting to roll out of those into next year, so we should start to see some easing of those you know, gross margin pressures into the next few quarters.
Foot Locker, I mean, that stock's been a disaster. It's been hammered this year. How much of a read-through to Nike is that name still?
I mean, I think part of Foot Locker's challenges are the relationship and the situation with Nike, where Nike is pulling back on its, you know, strength in, you know, the Nike distribution platform. Foot Locker is becoming less and less a critical part to it. Nike's been focused more on its DTC. So I think part of the challenge with Foot Locker is, you know, the Nike business, but it's also the lack of the non-Nike brand strength. And I feel like the industry's definitely weakened a bit. It's gotten more promotional. And I think Foot Locker's gone into this with a little heavier inventories than they would have anticipated as well.
Got it. Bob Drbul, thanks for joining us.
Thanks, Mark.